Good afternoon, guys. Let me just go to my screen. Okay. So for today's topic, we're going to talk about international debt markets. Basically, we'll be focusing on the banking sector in the international landscape. So let me just go through the brief agenda. So similar to before, I'm just going to go through some of the main points for the lecture, and then we'll move on to the tutorial questions. Okay. So for this week, as you have already seen in the lecture slides, it's quite theoretical. So the first key point that you need to understand in this topic is you've got to understand the differences between the local currencies and the euro currencies, right? So when we say euro currencies, we're talking about a currency that is traded outside of its nation. So for example, if the USD is circulated in the US, then this is the US national currency. But if we trade or if we transact using the USD outside of the US, this is when we create the euro dollar. Okay, so euro just means international. So as we have discussed in one of the earlier weeks, the USD is one of the most popular currency for international trades around the world. And at the same time, with international funding, like if you talk about the banking sector or the bonds market, euro dollar bonds are quite popular as well. Okay. The second key point that you need to understand is interest rate risk in the euro credit markets and hedging interest rate risk using forward rate agreements or FRAs. Okay, so we discussed that. So in the lecture, we sort of introduced a few short-term credit instruments in the euro market. And as they are interest rate instruments, when you trade them, you're exposed to interest rate risk, right? So for example, if I buy a bond, let's say if I have an investment horizon of a year, but my strategy is I would just keep rolling over three-month bonds, right? So every 3 months when I roll over the bond, I'm exposed to interest rate risk at the time, okay? So when I roll over my investment, if I have to roll over at the lower interest rate, then that is when my income will reduce, okay? So I've got a question in the chat box about the quiz. So let me go through the topic today first, and then during the break or maybe at the end, feel free to ask me about quizzes and everything, okay? So let me just focus on the topic for now. So where were we? Right, so if I'm lending and if I roll over my loan, when I roll over at a lower interest rate, then my income will be reduced. So for me to make sure that my interest income can be hedged, can be managed, I can enter into a forward contract on interest rate instruments, okay? So these contracts are called forward rate agreements, or FRAs for short. And we'll look at some of the applications of using FRAs for interest rate risk hedging later on, okay? Besides FRAs, people also use the futures contract on interest rates for hedging purposes as well. Finally, for this topic, the second part of the topic talks about two large debt financial crises in the past, including the Latin American debt crisis in 1982. And the second one was the 2007 global debt crisis, okay? So the key similarity between the two crises were that they were debt crises, okay? So they was caused by a debt, by over borrowing of the countries or the companies involved. So for this particular topic, you need to understand the major causes of the crisis. So for each of those two crises, the causes were different, right? And we'll talk about these crises in detail later on. You've got to also understand the role of the banking sector in each of those. So for both of these crises, the banks play a big role, right? in overlending and therefore causing a lot of moral hazard problems. Okay. And finally, you've got to understand the implications of the crisis for the international banking landscape. So what happened afterwards? What happened to the regulations? What happened to the banks that are involved? What were some of the solutions that people came up with to solve the crisis? Okay. So I'm going to talk in detail about these crises because, as you will see, this is a theory topic, and if it comes up in the exam, it will be theoretical, right? So I think it's good to discuss some of these details with you guys in class. So with the debt crisis in 1982, it happened in Latin American countries, okay? So the start of the crisis was in August when Mexico basically defaulted on their bonds. Okay, so the Mexican government defaulted on their government bonds. So before the crisis happened, there was a long period where the oil producing countries accumulated a lot of money from selling oil, right? So because of the amount of money that they accumulated, they started to look for investment opportunities. So what they did was they deposited the money that they got from selling their oil into the euro-dollar market. So basically they're lending to international banks. So what it created was a big supply of deposits or a big supply of money that the banks were desperate to invest, okay? So due to this liquidity, a lot of banks started to look for investment opportunities. And at that time, third world countries were one of the attractive options because of the high promised returns, okay? So they were a bit riskier, and as a result, the banks can charge them higher risk premium. Now, what happened here was that these third world countries, because they were developing, they had a large demand for oil, okay? And so what happened was it created a process called petrodollar recycling, where the oil countries deposit money into the banks, who in turn use that money to lend to the third world countries. And then the third world countries use the money that they just got to buy oil from the oil producing countries, okay? So it created a circle where money got circulated. Sorry, my drawing here is not too good. So here we've got the OPEC countries that produce oil and get money from their production. So they lend money to the banks, who would then lend money to third world countries, who in turn use the money to buy oil from these countries, okay? So money just keep flowing around. So everything was okay up until a point where the oil producers started to raise their oil price, okay? At the same time, a lot of countries started to tighten their monetary policies. So that created a economic downturn in the world. And as the economy was going down, the third world countries started to make less money on their income. So because they were over borrowing in the 1970s when money was cheap, when the economy was going down, they ran into problems because now they find it very hard to pay back their money, okay? At the same time, because they were borrowing in the USD, so they were borrowing in the euro-dollar market. So the money that the loan was denominated in was the USD, okay? So when the economies in the third world countries became weaker, their currencies became weaker relative to the USD, which further increases the debt burden. Okay. So as a result of this economic downturn, the third world countries started to default on their debt. And that was when the problem started to unfold. So in terms of the size of the crisis, at the height of the crisis, the debtor countries owe about $1.2 trillion, okay? And that was in 1982, right? So to put it in perspective, if you've got 1 million in $100 notes, it looks like this, okay? So it's still relatively small. If you got 100 million, you're looking at this picture here. And if you got a billion, this is where you are, right? So the third world countries were owing 1.2 trillion. And if you put it in cash, it kind of looks like this, okay? So as you can see, just from the picture, it's a little bit of a big burden. So if you put the size of the debt in terms of the country's GDP or GNP for gross national products, then it's up half of their GNP. Okay, so that was a huge amount of debt to bear. Interest payments as a result amounted to 22% of the export income. So in terms of the banks that were involved, so this is in $billion, I think. These were the top international banks that lent to the Latin American countries, and these are how much they lost. Okay. Anish asked, what is the full form of LDC? Sorry, I forgot to mention that's less developed countries. So LDC is for less developed countries.
Thank you.
So as an illustration, so normally for banks, they will have a loan loss reserve, right? So this is how much they put aside for the worst scenarios when they borrow default on them. So for Citicorp, for example, their total loss reserve was 3.4 something billion. And the debt to Mexico alone was about 2.9 billion. Okay, so that's probably about 70% of their total reserve. So this is how severe the crisis was for the banks that were involved. Okay. So the key things that we learned after the crisis was that we found that the international banks at that time were making too much loans to the Latin American countries, right? So some of the reasons why they did that was because they suddenly got a lot of money from the OPEC countries, and if they keep the money in their vault without doing anything with it, they will start losing money, right? So they've got to find a way to earn interest income on the liquidity they've got. So as a result of this pressure to earn income, they start to lower the lending standards, and they start to take more risk. Okay, so as you take more risk, you've got more expected returns. Some people claim that they were forced to lend to the Latin American countries. So the key lesson here was that there was lack of diversification because they were involved, they were lending too much to a very risky segment of the market, okay? So this is typically one of the root causes of many crises that we have seen in the past. So whenever you've got easy money, when the banks start to loosen their lending standards, that is when moral hazard comes into play, okay? So moral hazard is when after you lend money to someone, for example, they will start to take risky actions that will potentially lose your money. Okay. So in the bank's case, because they were facing with a lot of liquidity pressure, they started to lend without taking too much caution. Okay. And as a result, they lend to they overlend to risky borrowers. If you like. So after the crisis, people were trying to find different solutions to solve the problem because nobody wanted to lose 100% on their debt investment, right? So one of the solutions for the problem was a structure called debt for equity swap. So in this case, you agree to restructure the debt between the banks and the debtor nations. So you're going to introduce a third party, being a multinational company that wants to invest in the debtor country, right? So in this structure, everyone will have to compromise. So the bank will have to give up some proportion of their loans. So they're going to sell their loans to the multinational company at a lower price. So they take some percentage of losses. And then the multinational company, they will be negotiating with the debtor nation to recoup some of the loans, right? Some of the losses on their loan. So I'll show you an illustration later on. So in a typical debt for equity swap, now these are the two original parties to the contract, right? So you've got your creditor being an international bank, and then you've got your debtor country. So let's say this is Mexico. So originally, let's say this is Citicorp, and this is Mexico. So originally, the bank will lend to the country and expecting to get back 100% of their loan plus interest. But in this particular case, because Mexico is running into a problem and they default on their loan, right? So technically, under a loan default, the bank is going to lose everything net of their collateral, right? So instead of losing everything on their loan, they're going to introduce an equity investor or a multinational company that wants to invest in the debtor country, being Mexico in this case. Let's say this is PHB. So under this agreement, the original bank agrees to sell off their loan to the third party, to the multinational company at a discount, right? So here they get to sell the debt at 60%, meaning they recoup 60% of the debt rather than losing 100%. So what this multinational company does is that it's going to bring the debt ownership to the debtor country and redeem it at 80%, but in the local currency, right? So here, the bank will, the company will pay the bank in the USD, which is the original currency. But when they recoup the money from the debtor country, they allow the debtor country to pay back in their local currency, right? So in this case, the debtor country pays back an equivalent of $80 million to the company in the local currency. So why is this an attractive feature for the debtor country? So number one, if you can pay in your own currency, you have the option to bring money to pay off, right? So you have more control in this case. Whereas if you pay in the USD, you've got to make sure that you have enough reserves of USD to pay. The second reason is as these countries run into trouble, their currency starts to depreciate relative to the USD, right? So as a result, if you have to pay back in the USD, over time, it's going to be more costly for you. Whereas if you pay in the Mexican peso in this case, the currency will be relatively weaker relative to the USD. So you don't have to worry about the currency costs of your loan. So weaker currency. Right. So the reason why the multinational company wants to be involved in this debt equity swap structure is firstly because they got to earn the spread in between, right? So here they earn a spread of 20%. The second reason is they already have an interest in investing in that country before, right? So if you want to invest, let's say in Mexico, and you think that by participating in this structure, you get a very attractive opportunity to obtain the local currency and at the same time earning some spread in between, okay? So for this multinational company, this is the benefit for them because it gives them the chance to obtain the local currency to invest, right? So throughout this structure, all of the parties involved should benefit. So the international bank, in this case, get to recoup 60% of their loan. The local bank, the central bank of the debtor country, gets to pay back the debt at a lower rate, so at 80%, and they get to pay in their local currency as well. For the middleman, being the multinational company, they get to earn the spread as well as they've got the local currency for their future investment, okay? So one of the long-term impact on the debtor country's economy is something that we have to think about, right? So when you invite foreign investment in the country, something you have to worry about is also the foreign ownership of the country's assets, right? Which is something that we are currently debating in Victoria right now. So these are some of the concerns that people raise later on about ownership of assets, right? Foreign ownerships of a country's assets. But in terms of restructuring like a trouble debt, this is a very attractive option for both the banks and the international companies. So the question is how popular it was, right? How popular was debt for equity swap? So after the debt crisis in 1982, we found that on average, Latin American debt was selling at a discount for 70%, right? So most of the debt was discounted by 30%. A lot of American companies and European companies also used the opportunity to establish factories in the Latin American countries, okay? A second solution for the debt crisis in 1982 was something called a Brady bonds, named after the US Treasury Secretary at that time, Nicholas Brady. So essentially, this guy, he proposed three different alternatives for the banks. Number one, like they could either convert their loans into bonds and they sell it in the market, okay, at the discount of 60%, 65% of the original loan value. So basically, they asked the banks to forgive 35% of the debt. Alternatively, the banks were given the option to convert the loans into collateralized bonds at the reduced interest of 6.5%. So what that means is that the banks agreed to reduce the interest that they charge on these Latin American countries. And finally, the banks have to lend even further to these countries to get them out of trouble, right? So the most popular vote was for the second option. And as a result, the bonds issued under this option is called Brady bonds, okay? So how do Brady bonds work? So basically, the banks get to keep the same principal, so the same amount of loans. The only thing that is different is they're going to change the interest rate. They're going to reduce the interest rate to 6.5. Okay, so essentially, when you reduce the interest rate and you keep the principal the same, then you increase the debt maturity, right? So you extend the debt maturity to longer, which means the countries take longer to pay their debt. The second feature that is introduced is collateralization, okay? So the debtor countries were required to put a collateral on these bonds, and the collaterals were the US Treasury bonds, okay? So these countries have to buy US Treasury bonds to use as collateral for these original loans. So this package is called a Brady bond. Okay. So besides debt equity swaps, Brady bonds were also one of the popular solutions for the 1982 crisis. Okay. All right. So the second debt crisis that we introduced in the lecture is the financial crisis 2007-2009. And this is something I think you have also talked a lot about in other subjects as well. So unlike the crisis in 1982, which was an international debt crisis where your debtors come from different places, the financial crisis in 2007 started with the USD subprime mortgage, right? Anish asked me Greek. What is it, Anish? Can you explain?
I was just like wanted to know, is it like financial crisis 2007 and 9? Is it about Greek or something?
No, the Greek debt crisis was in 2010. So that was the aftermath of this.
Oh, okay, yeah, sorry. Thanks.
Yeah, so that's a good question. So the Greek crisis was one of the following up crises, I guess, after the financial crisis in 2007. So the crisis happened sometime in 2007 and up until 2009. And what started as a national crisis became a global crisis, right? Because as we saw later on, as we discover later on, a lot of financial institutions these days are globalized, okay? And a lot of investors, because they got access to different international markets, it gives rise to a contagion effect for when one crisis could transfer to different places, okay? So the crisis started with the credit crunch in 2007. And this was when people started to find that it's hard to obtain new credit, okay? So the credit crunch means the credit markets just dry up. So the three main contributing factors, and this is something that you need to understand for the exam. So the three things that happened in the period leading up to the crisis was something that we saw before. Number one, there was a liberalization of the regulations in the banking and financial sector. And second, there was an increase in liquidity, right? As Asian countries, for example, China or Japan, became richer, or India became richer, and they started to accumulate wealth. Okay. And finally, the interest rates at that time were quite low. Okay. So when we talk about the liberalization of the banking and securities regulation, so in a previous topic, I think when we talk about the payment system, we said that the deregulation of the financial sector was one of the key factors that helped globalization, okay? But at the same time, as you remove a lot of restrictions or regulations on banking activities, it creates more risk-taking in the banking sector, right? So, for example, in 1999, the Glass-Steagall Act of 1933 was removed. And basically what this act did was that it separated different banking activities, right? So for example, if you're a commercial bank, then you can only take deposit and lend. You can't get involved in securities or brokerage or financial advising, so on and so forth. So before this act was repealed, it was very clear, like if you're a commercial bank, you can only do commercial bank. If you're an investment bank, you can only do investment bank, so on and so forth. The key reason for this act was that it allows the regulators to regulate the commercial banks properly. So traditionally in an economy, commercial banks play a very important role because they keep our money, right? So everyone who works, everyone who has a salary will get paid into the bank account. So most of our wealth is going to stay in our bank, in our commercial bank. So because of their crucial role in holding people's money, typically commercial banks are very heavily regulated. For example, they've got to hold a certain amount of capital. They've got to hold a certain amount of liquidity ratio, so on and so forth. With the other financial institutions like investment banks or insurance companies, so on and so forth, they are regulated, but to a lesser extent, right? So for example, with investment banks, they still have to adhere to certain rules. For example, they can't do insider trades. But their regulations are not as hard as commercial banks. So what happened was the commercial banks were not too happy, and so they've been lobbying for the rules to be removed, right? So in 1999, they successfully lobbied for the repeal of this Glass-Steagall Act, and the result was that they were allowed to be involved in different other banking activities, okay? So it causes a blurring of the functioning of different banks. And this is where it's going to be harder for the regulators to monitor the banks, okay? So as I mentioned before, commercial banks were heavily regulated, whereas the other banks or the other financial institutions are not. And because of the repeal of this Glass-Steagall Act, the other banks started to also take advantage in commercial banking activities as well. Okay, so everyone can do whatever they want. To put it simply, so the result of this was that it created a shadow banking sector where the banks that are not regulated are also involved in the commercial banking activities. Okay. So the problem is we allow everyone to do whatever they want, but we only regulate just a segment of the sector, which is the commercial banks, and we leave this sector unregulated. And as you can see, it creates potential trouble, right, for moral hazard.
Excuse me.
Yeah, sure.
Yeah. Is there any banks or companies you can relate to highlight the last point, or shadow banking risk system redeveloped and was not well regulated?
Good question. Let me think about it. I can't think of one on top of my head, but I can find out, I think. So I think Lehman Brothers were a bank, a commercial bank before, but they were involved in investment banking activities. So your question was, is there any investment banks that was participating in commercial banking?
Yeah.
Yeah, I'll find out for you, but I can't think of one at the moment. Sorry.
Yeah. No. Thank you.
Yeah, let me just note it down, otherwise I'll forget. Okay. So the second factor that we talk about was a increase in liquidity, right, in the global market. So before 2007, a lot of countries were starting to become richer as they escaped poverty. So, for example, China accumulated a lot of wealth in the period before 2007. Also, the OPEC, the oil producers. Okay, so as these countries were investing more and more in financial assets around the world, they created a lot of liquidity in the system. Well, the consequence of a lot of investment, especially in the US market, was that it made funding in the US very cheap, meaning interest rates were very cheap at that time. Okay, so it's easy for you to borrow. And as you can guess, as people find it more easy to borrow, they will start to overborrow. Okay. So besides the liquidity from overseas, the US government also was keeping interest rate very low. So the history of that was because after the dot-com bubble in 2001, the US central bank was trying to stimulate their economy, right? And as a result, they cut the interest rates to make sure that people can spend and invest and boost their economy. So in the mortgage market, as people were facing with low interest rates and a lot of liquidity, they started to demand more for mortgage loans, okay? And similar to what we saw before, when interest rates are low, when liquidity is high, the banks start to lower their lending standards and they start to lend more to subprime mortgage borrowers, okay? Let me check my chat box. Chandrima said that there is an excellent documentary named Inside Job. Yep, that's something that you should watch. It's very informative, explaining the global financial crisis. Chandrima, I'm just going to share the link to other people. Is that okay?
Yes, sure. I was supposed to send, but I accidentally sent it to you.
Oh,
I didn't
okay.
realize that. Yeah.
That's all right. Thanks, Chandrima. So so if you haven't already, you can look at this Inside Job document where they interview a lot of different economists, investment bankers, so on and so forth, trying to find out what happened during the crisis. And I find that very informative. Okay. To add to the problem, so a lot of people at that time, when credit was cheap, they also borrowed for consumption, okay, which is not a very good thing to do. You don't want to be over consuming as well. So we have talked about this crisis before, so I'm going to just skip through some of the things that are discussed before. So the subprime mortgage as we mentioned before, was booming during the period before 2007 because of the cheap credit and a lot of liquidity, right? Now, as people started to demand more for mortgages, the banks came up with this idea called securitization, where they package their mortgage loans and they sell off to investors in terms of securities, okay? So the reason why the banks want to do so is because when they sell the loans to investors, they get the money back, which allow them to further lend to other people, okay? So it makes, it transforms a very illiquid asset like a mortgage into a more liquid asset, which is an security, right? Which they can sell to investors. So one of the negative effects of mortgage-backed securities was that it allowed risk to transfer across the economy, right? So anyone who holds a mortgage-backed security is now exposed to the risk of the mortgage market, okay? Not just the bank. So in terms of the mortgage-backed securities market, there were two big players in this market, being structured investment vehicles and collateralized debt obligation, okay? So I'm gonna have two tutorial questions related to these structures. So for now, I'm going to just briefly talk about it, okay? So an SIV, or special investment vehicles, is a trust entity that is created by a bank, and it is controlled by the bank, okay? So this entity is off balance sheet in the sense that they are contingent liabilities for the banks. So they will not be recognized on the balance sheet unless any gains or profits are realized, okay? So one big problem here. So when they are off balance sheet, the banks don't have to report them in their consolidated statement. And so people will not know about it until it's too late, until the problem is already recognized. The second problem here is with the way that SIV is funded. So SIV is a separate entity, and they buy the mortgages from the bank, and then they create MBS from the mortgages to sell to investors, okay? So on the one side, on their asset side, they own mortgages, which are long-term in nature. And on their funding side, they fund their purchases using commercial papers, okay? So commercial papers are short-term debt instruments. So there's a funding mismatch, there's a liquidity mismatch here in the way that they are funded. So they are funded using a lot of short-term securities, and at the same time, their asset is very long-term, okay? The last feature of SIV is that they, because they hold mortgages, yeah, so they buy the mortgages from the banks. So essentially, they are exposed to the mortgage, the default risk of the mortgage. So if the borrowers default, then their asset will lose in value. All right. Collateralized debt obligations is something similar to mortgage-backed securities. So in this case, this is an entity that also hold a portfolio of fixed income, and then they write different tranches, they write different securities based on their portfolio and sell to investors, okay? So CDOs were around for a long time, and before this financial crisis, they were specialized in junk bonds, okay? So they were specialized in the lower than investment grade bonds. And then when this subprime mortgage came about, they started to also get involved in the subprime mortgage market. Okay. So as we mentioned before with the SIVs and the CDOs, the way these companies make profit is that they buy a mortgage and then they sell securities to people, right? So when they sell securities to people, they put them into different tranches based on the riskiness of the tranche. So for investors, let's say if I buy a AAA mortgage-backed security, this is deemed to be the safest security, right, in the mortgage pool. In contrast, if I buy like a BBB mortgage-backed security, so this is still an investment grade security, but it is not as safe as the AAA, okay? So if I want to hedge the credit risk of this BBB mortgage-backed security, what I can do is I can buy a credit default swap. Okay, so a credit default swap is similar to an insurance contract written on mortgages. Okay, so the person that sells you the credit default swap is basically guaranteeing that if a default happens, if your borrower defaults, then they are going to pay back the loan to you. So, for example, if I've got like a 5-year credit default swap contract on a notional amount of 100 million, right? So let's say I've got 100 million securities to hold, and I want to buy an insurance for my portfolio for 5 years. This is what I'm going to buy, okay? I'm going to buy a 5-year credit default swap, and I'm going to pay to the insurer 80 basis points. So 80 basis point is 0.008. Okay. So how it works is that for every year in my contract, I'm going to pay an insurance premium of $800,000 on my contract sites. So if nothing happens, then I'm just going to pay until year 5 and then the contract expires. But if my portfolio happens to default anytime within that 5 years, I can bring the bonds back to the credit default swap seller, and then I can claim back $100 million. Okay, so it's similar to like a car insurance, I guess. So the main problem with credit default swap was that a lot of the financial institutions that sold credit default swaps were mono insurers. So this is a term that we use to describe an insurance company that only sell one type of insurance contracts. Okay, so in this case, for example, I think that was Bear Stearns. So Bear Stearns was involved a lot in credit default swaps before. Okay, before they went bust. So if you sell a lot of credit default swap on mortgage-backed securities, basically your whole business is going to be exposed to the default risk in the mortgage market. Okay, meaning that if there is some problem in the mortgage market, it's a very high chance that all of your buyers is going to claim the insurance against you. Okay, so the event risk here is very high for the insurers. And that was one of the reasons why a lot of financial institutions went bankrupt during the GFC. And that was actually what happened during the GFC, right? So when the economy started to go down, when the US economy started to slow down, and when interest rates started to increase, a lot of people started to default on their mortgages. Okay. So as a result, a lot of the CDOs or the SIVs that were involved in mortgage-backed securities started to find that they were stuck with a lot of mortgage-backed securities that they could not sell to investors. Okay. And at the same time, their portfolio value started to go down. To make the matters worse, the credit rating firms at that time realized that they overestimated the mortgage-backed securities, and they started to downgrade these instruments, right? Making it even more expensive for CDOs and SIVs to further raise their funds. Okay. So we sort of talked about this before. So as the crisis started to worsen, a lot of the mortgage-backed securities holders claim against the insurers, right? Claims against these CDS insurers, creating a liquidity pressure for them, which triggers further downgrades or default even. So the consequences was that when these insurers fail, the banks that rely on them started to find that their portfolio value decreases in value, right? And that further erodes their tier 1 capital basis. All right. So in terms of numbers, how severe was the crisis in 2007, 2009, right? So for me personally, that time I graduated from my bachelor in 2009. And before that, banking was a very popular sort of industry to go in. So I was very excited as a graduate to go into the job market. And the crisis just messed everything up. So after 2009, it was really hard to find a job in banking, okay? So from an employment point of view, it is not very good. So to illustrate how the crisis unfolded in numbers, we can look at the credit spread, right? So the credit spread is the spread between the 3-month euro-dollar bonds and the 3-month T-bills, okay? So the 3-month euro-dollar bonds has some credit risk, whereas for a government bill, we assume that it is risk-free, okay? And as a result, the difference between them reflects the credit risk of a 3-month investment horizon. So as you can see, up until this is October 2007, the TED spread was pretty low, but it started to spike up in 2007. And at the peak of the crisis, it was really high, right? So this illustrates how much credit risk was in this sector during the crisis. So the consequences in terms of the financial industry was that a lot of the banks started to default, okay? So Northern Rock, Bear Stearns, Bank of America, Merrill Lynch, so on and so forth. So they were all getting into troubles, and some of them even defaulted. The impact of the crisis on housing could also be seen on this graph over here. So this housing index tells you, this is similar to a consumer price index. So it tells you the value of the houses in the US. So up until the crisis was unfolded, the house value in the US was increasing, right? It started to decrease around early 2007, and it just kept going down up until 2009. Okay, so this is where if you have to sell a house during this time, this is a really bad thing to do, okay? In terms of unemployment, we see a similar picture here. So the unemployment rate in the US was quite stable. It was less than 7% up until the crisis. And during the crisis, there was a huge spike, right, in unemployment to 10%, and it only improved gradually over time, okay? So even up until 2015, 2015, 2016, it still did not get back to the original level yet. So the lesson here is a crisis could be a very devastating event for an economy, and it takes a long time for an economy to recover. Okay. All right. So in terms of the responses, so similar to what we've seen today in terms of this COVID crisis. So after a crisis, normally central banks will have a lot of packages to help boost the economy. So in the US, to name a few, you've got decrease in interest rates, you've got different stimulus packages, you even have like a commercial paper facility to help companies to raise short-term funding. In terms of the international policies, a lot of other countries also follow the same strategy where the central bank basically cut interest rates. Okay, so in Australia, for example, during the crisis, the interest rates were cut from about 2.75 to 2.25, I think. Okay. Right. So Australia did really well in the 2007 crisis. One of the reasons was that because our banking sector was very well regulated, the banks held a lot of capital, and they did not get involved too much in the subprime mortgage crisis in the US. Okay.
Excuse me, ma'am.
Yeah, sure.
Yeah, in the previous slide, the third point, they established the commercial paper facility to buy 1.3 trillion in commercial paper. Is that the capital injection thing the Fed respond with?
The quantity easing. Yeah, it was part of it. So, so remember, one of the problem was that companies could not issue any commercial papers anymore. And this was one of the programs that helped companies to issue commercial papers. Is that what you're asking, Budi?
No, somewhere I read about the capital injection the Fed did.
I think that belongs to quantitative easing, I think.
Major investment banks during that time. So
Yeah.
is this the point that supports? Right.
No, this is for companies in general. So commercial papers are issued by corporations. With banks, they normally trade in the interbank market. So it must belong in this category here.
Okay, yeah, sure.
Yeah, so there was a lot of capital injection in the banks. Yeah.
Yeah, thank you.
Yeah. But this is particularly about the companies.
Oh, okay, yeah.
Yeah,
sure.
the corporate sector.
Thank you.
Right. So we are now 5 parts 3. Is there any questions about this topic at all before we move on to the tutorial questions?
Yeah, I just want to know your view about the current situation, and then how do you compare the crisis happening right now with the global financial crisis in general? Anything you want to say?
Yeah, so I guess, well, when this crisis happened, I really didn't think that it's going to be this severe because, well, we have gone through some pandemics in the past before with SARS or with MERS. And it wasn't becoming a global scale like this. So back in February, I was hopeful that by June, we'll be back to normal, but it didn't happen. So I think the key difference between this crisis and the previous crisis was that the previous crisis was financial crisis, right? This is an economic crisis. So I think the scope would be more severe. Okay. Unfortunately. Yeah. And there's a lot of uncertainty in this crisis as well. Whereas in the previous crisis, you sort of can pinpoint where the problem is, and that's where you try to fix the system. Yeah, in this case, I think it's a bit unprecedented, and it's unexpected in a sense.
Also about the housing market right now, the government is lowering the interest rate.
Budi, I'm losing you for some reason.
Minimal criteria to buy a house.
Can you repeat?
Can you hear me?
Yeah, I can hear you now.
Yeah, the house buying criteria right now, it's going down to 5,000 minimum, something like that, about the deposit, and then the
5%.
very low interest rate. Do you think it's going to be a bit?
I'm losing you again, Budi. I'm sorry.
Then afterwards, when the interest rate goes up, once they.
Can you repeat the second part after the 5%?
Yeah, in the long run, do you think with increasing the interest rate, it's going to be an issue about the default in the home buying side, in the housing market afterwards?
Good question. So I guess it depends on how you regulate the market as well. So in the US, in the subprime mortgage crisis, everyone could borrow very cheaply, and everyone could basically get money, right?
Yeah.
So in Australia, I think the 5% was targeted to first home buyers. So it's not that they are going to, let everyone borrow a lot and invest a lot.
Yeah.
So only first home buyers.
Yeah, it's not in the huge quantity. It's just in total it's 30,000 units all over the country, but.
Well, I don't think there's one thing that was concerning me. So I read on the news the other day that the banks were allowed to loosen some of their lending standards.
Yeah, and that's what I relate to the crisis that happened in 2007, 2009 in GFC. There were similar criteria is happening, and then the interest rates were low.
Yeah, so that's something that worries me. But the first home buyers is something that I don't think is going to have a big impact on the entire economy.
Yeah.
And also in the previous crisis, in the context,
also had this.
Go on.
Yeah. Before the housing market crashed in the US, the basic concept about the housing market in the banking industry and everything, where it's too strong to fall or to crash, but and then it happened.
Exactly.
And also here in Australia, the same thing is happening. We are assuming that it's the first buyer. Small, but do you think we have enough policies in right place in the current situation that we can handle it in the long term after 3-4 years when we are recovering from the crisis? Or you think we should improve? We need to improvise or bring in new policies to stand the decision afterwards?
So normally with these kind of easing policies, after a while they will be wide back. But so I think at the moment the banks, one of the good things about the banking sector in this current crisis is that they are much stronger than in 2008. So remember in 2008, we've got a different set of regulations where off-balance sheet activities were not recognized. So they were taking a lot of risk that we didn't know about. They did not have a lot of capital and they did not have liquidity buffers. So after the crisis, they were asked to basically repair their balance sheet a lot. So right now their balance sheets are quite strong. So they're quite healthy. So I think at least in Australia, I don't think we are going to see a crisis of that scale, like in 2008 in the US.
Mhm.
Yeah, so I might be wrong, but I think the banks right now are quite healthy, financially healthy.
Yeah. The reason I raised about the default concern was most of the banks recently, in last few weeks, they asked their borrowers, after they postponed their payments, they asked their borrowers to access their superannuation fund to repay the
To pay back.
yeah.
Mm.
It may be because their position isn't holding much. It's been more than 6 months now. And then also most of the not most Australian citizens and then the PR, these people are on government support.
Yeah, that's a good point as well, Budi. Yeah, this is something that we did not see
Once the
before.
government stops continuing the fundings, do you think the economy has enough movement that people can be will be able to,
I'm losing you again, Budi.
if we consider these points?
Can you repeat the last part? Sorry, I think my internet is not too great today. What was the last?
Yeah, I'm having the same issue. Yep. Do you think the people, there will be less default, that it senses because of the job keeper and job seeker? It's not gonna be for long now. They have already reduced it to 50% or so, and then the banks are suggesting to access their superannuation to pay their debt. And do you think the economy is in a good position to get all those workforce back to normal, to get going or be able to own their debts?
Yeah, so it will depend on whether we'll stay in the lockdown for long or not. Well, at the moment, if we are going to be locked down for another year, I think everyone is going to lose their houses and their jobs and everything, which is not very positive to say.
Yeah.
But yeah, it depends on how long the lockdown will go for. So yeah, it's very hard to say, Budi. What about other people? Are there any other ideas? I think at least until the end of the year, we will not see a large scale default in the housing market.
Yeah.
And people were even forecasting that the crisis was not as severe as they thought. But it all depends on, the lockdown in particular in Victoria. I don't think we can afford to stay in lockdown for a year or so.
Yeah. Okay. Yeah.
What about the other people? Any other ideas? Do you want to contribute to Budi's question? No? Yeah, that's a very good thing to think about, especially if you think about investing in the housing markets in the short term. Also, one thing to think about when you want to invest is the current renting market as well, right? So right now, the vacation rate is quite high. It's getting quite high because people are moving back to their homes, so on and so forth. So if you if you buy a house and you want to rent out, it's going to be hard as well. So yeah, all in all, I think this year at least, I don't think there will be a major housing crisis. But next year, if we stay in lockdown, then anything can happen.
Yeah.
Yeah, and you got to think about with international students and international travels, that's where most of the rentals come from as well, right?
Yep.
Yeah. So anyway, thanks for the question.
Yep. Thank you.
Yep. So let's take a short 5 minutes break, and then when we come back, we can go through the tutorial questions. Okay. So I'll be here. If you have any questions, you can either ask me or put it in the chat box, okay? But I'll
Yeah,
turn off
sure.
my video and microphone.
Yep.
Okay, allow me to get back to the lecture slides. And let's start our tutorial questions, okay? So in terms of the questions today, hang on 1 second. Let me change my internet to make sure that the call doesn't drop in between. 1 second, guys. I'm sorry it wasn't stable before, so I couldn't hear a lot of things that you guys were talking with me. All right, can you hear me better? Can you still hear me, guys?
Yeah, I can hear you better now.
Okay,
Better
cool.
connection.
Thanks.
Yeah, we can hear you. Thank you.
All right, so let me start with the first question, which is question 5. Discuss the cause and solutions to the international banking crisis involve the less developed countries. So that was about the 1982, I think, crisis. Now, we have talked about this before. So did someone want to summarize the key points of the cause and the solutions for this particular crisis? So this was the 1982 debt crisis. Right, we're very quiet today, so I'm just gonna go through. I'm just going to talk about this briefly because we have already talked about it before, right? So with the debt crisis in 1982, the main cause was that the banks were lending to over-lending to one segment of the market, which is the Latin American segment, right? So there was too much concentration to lending to borrowers with the same risk profile. And as a result, when they defaulted, they tend to default at the same time. And that caused a big problem to the bank lenders. So in terms of the solutions, we mentioned before that there were two main solutions that came out of this crisis. The first one was that they enter into a debt restructuring where they swap debt for equity with the international companies, right? And the second solutions was the banks agreed to reduce interest rate on these countries and they extend the maturity so that the countries can have a longer time to pay off their debt. Okay. So one of the key interesting things about debt crisis was that if you compare the debt crisis and let's say an equity crisis, like the dot-com bubble in 2001, normally with debt crisis, they tend to be more severe and they tend to take longer to recover, right? That's because with equity investors, the investors that invest in equity tend to be more wealthy, whereas with debt crisis, it could involve anyone with any kind of income. Okay, so for example, with the mortgage security crisis, a lot of the people that were worse off were the mortgage borrowers. So those were the lower income borrowers that got affected by this debt crisis. So on average, in the past, debt crises tend to have much more severe impact, especially on the lower income people or countries. Okay. Question 6. So this is this relates to Billy's question before, right, about the banks as they emerged from the crisis in 2007. So the question is, what were the weaknesses of Basel II that became apparent during the global financial crisis in 2007? So to answer this question, we need to understand what Basel is first, okay? So Basel is a set of guidelines for bank regulations established by the Basel Committee in 1974. So it went through a few rounds of updates and changes, and typically it follows like a certain flaws or certain limitations that people found out over time. So the first Basel rules were Basel I in 1988, followed by Basel II in 2004, and finally Basel III in 2010. Okay. So as the regulations evolve, you see more details or more refined or more regulations that are recommended by the Basel Committee. Okay. So with Basel I, it was basically just about the 8% of capital requirement for commercial banks. And this 8% is calculated off the entire asset portfolio of the bank, okay? So for example, if I have a portfolio of 100 million, I'm required to have at least 1 million in capital. And this serves as a buffer against the losses that I make when I lend out to people, okay? In Basel II, they refine the regulation a bit. So on average, banks are still required to hold 8% of their assets in capital. But they change the definitions of asset, okay? So here they allow for risk-weighted assets in the sense that if I have $100 million in very safe asset, and at the same time, if my competitor have the same $100 million in asset, but in very risky asset, then if you compare the required capital between these two banks, you will see that the first bank holds less capital than the other bank, okay? So as your asset becomes safer, you're required to hold less capital. So the change in Basel II was to recognize that if you take too much risk, then you're penalized more by the capital requirement, okay? With Basel III, so Basel III came after the crisis in 2007. And after the crisis, people started to realize that there are different types of risk that the minimum capital requirement does not cover, okay? And as we discussed before, some of the risks that we discussed before were off-balance sheet risk, liquidity risk, and operational risk, right? So just to reiterate, so the problems that we found after the GFC was liquidity, okay? So banks were relying too much on short-term wholesale funding, and so did the corporate sector, right? So because interest rates were very low, and because people were expecting that an upward sloping yield curve is going to happen all the time, they started to borrow at the shorter end of the spectrum. So a lot of banks were relying on short-term wholesale funding in the interbank markets rather than core deposits, right? So there was excessive risk, liquidity risks in the sector that was not fully accounted for. And second, as we mentioned before, off-balance sheet activities were not recognized because they were contingent, okay? So for example, if you write if you write a credit default swap, a CDS, And if your buyer does not claim against you, then you don't have to recognize that liability yet. Okay, so CDS and mortgage-backed securities were off-balance sheet activities because they were contingent. So what it means is that you don't recognize the significance of these activities until it is too late. Okay, so with Basel III, they have a additional regulation for off-balance sheet activities as well. Okay. So some of the examples of the improvements in Basel III relative to Basel II was that, number one, they require higher quality for Tier 1 capital. So in the capital requirement that I mentioned before, you can have different types of capitals, right? Tier 1 and Tier 2. So Tier 1 is very safe, very high quality capital, and normally it's common equity, right? So from a bank's point of view, common equity is a safe type of capital because the shareholders are the residual claimants on the bank's asset, right? Meaning that if the bank makes a loss, then they can write their losses off the equity first before it has to go to the other debtors. So common equity is the highest quality capital, followed by other types of capital like subordinate debts or long-term debt, so on and so forth. Okay, so with Basel III, banks are required to hold more common equity, which is more costly for them. They also have to hold higher total capital. They can't take too much leverage in the sense that, and their leverage ratio is calculated off both on and off balance sheet assets. Okay, so the riskiness in the off balance sheet asset is also recognized in Basel III. In addition, they were required to hold a minimum liquidity ratio to ensure that they have enough liquid assets to meet any liquidity crisis, any short-term liquidity crisis. They have to have a minimum net stable funding ratio as well. So this is to recognize the fact that the short-term funding in the interbank markets could dry up unexpectedly, right? So in this case, they've got to make sure that they've got some stable funding sources like core deposits. So deposits like from you and me or from big investors. So normally for us, we don't just withdraw funds in and out every day. So that's, in a sense, that's safer than the short-term interbank market. Okay. In addition to that, they've got a whole additional capital for counter-cyclical effects. Okay, so that means in a downturn, they've got to hold more capital than in an economic upturn. Okay, so this is to make sure that they can absorb losses when the economy is not doing too well. So Australia, I think we were one of the first countries that adopted Basel III, and followed by other countries. So this is one of the reasons why I mentioned before that the banking sector as of now is much safer than the banking sector back in 2007, because they repair their balance sheets pretty well after the crisis. But yeah, but if you let this crisis go for a long time, I think everyone will be affected. All right, any questions here? I'm happy to upload additional information on these Basel regulations if you're interested. But for the purpose of this subject or your exam, you're only expected to know some of the major differences, right? The major improvements in Basel III, like I mentioned on the slide. Okay, let me see how many questions we have got left. we've got about an hour and a half, and we've got two more theory questions and 3 problems. So because of the time constraint and because we have discussed some of these before, I'm going to talk briefly about mortgage-backed securities, so on and so forth, okay? I'm going to emphasize on the more complex concept, but for these, they're not too difficult to understand. So what is a mortgage-backed security, right? So a mortgage-backed security is when you've got a mortgage loan. So let's say I borrow money from you, and then so you've got a loan ownership, okay? So here is the bank. So when they lend money to me to buy a house, I basically give them like a loan certificate, whatever. So after the bank is entitled to the loan certificate or the mortgage, then they will tranche or they will create a portfolio of securities based on this mortgage and sell them off to different investors. Okay. So let's say this bank decides to separate the to issue 4 separate securities. This is unrated, right? Based on my mortgage loan, and each of the securities have different ratings, with the top one being the top rated and the bottom one being the riskiest one. Okay. So let's say my mortgage is $100 for simplicity. So for in good times, everyone will get paid, and if you get the top rate, the top tranche, you get paid the least. Let's say you get paid 2%. The second one is 3%, followed by 4%, and then this very risky one is 10%, right? So in good times, everyone will get paid, but in bad times, when I start to default on my mortgage payments, then the first person that is going to make a loss is going to be this unrated tranche. So the lowest tranche will lose out first. So after this tranche is wiped out, after I have defaulted more than the size of this tranche, then the losses will be borne by the second tranche, so on and so forth, right? So the last person to lose out is the 888 mortgage-backed investor, because they have the safest tranche, okay? So from a bank's point of view, this mortgage-backed security process is beneficial for them because they get to earn a fee income on issuing the securities, right? And at the same time, they get the money back to further lend to other people. So they get the liquidity, right? So they used to be tied up with my mortgage before, but through the securitization process, they liquidate the loan basically and get back $100, which they can further use to lend out to a second mortgage. And the process repeats, okay? So as you can see, because of these 2 features, mortgage-backed securities were very attractive for banks, okay? Question 10 is something that we talked about briefly before. So what is a structured investment vehicle and what effect did they have on the credit crunch, right? So to illustrate how a structured investment vehicle is like, let's look at this graph over here. So here I've got a bank and I've got a mortgage borrower, right? So these are the 2 original parties to a loan contract. So if you just make a traditional mortgage, you're going to be creating a contract between a bank and a borrower, right? So the bank give me $100. In exchange, I give them a certificate, a lending certificate, whatever. With a structured investment vehicle, this is an entity that is created by the bank and this entity is created for the purpose of securitization. Okay. So banks create this SIV so that they can securitize the mortgage to investors later on. Okay. So what happens is banks will establish a wholly owned entity called an SIV, and they sell the loans to this SIV. Okay. So now the loan mortgage belongs to the SIV. In exchange, they pay back the bank $100. So essentially, the banks have liquidated their loan mortgage to the SIV, who would then write securities to sell to investors. Okay. So investors now have ownership, a part of the ownership of the mortgage. In exchange, they pay back the SIV plus a fee income. Okay. So through this process, essentially money flows from investors through to the SIV, through to the bank, and through to the borrowers. Okay. So essentially through a securitization process, you create two contracts between the investors and the mortgage borrowers. The key problem with this process is that with the original model where you just lend to your borrower and then the borrower pays back to you, it's very clear who's going to monitor who. Okay, so if you lend money to people, you've got to make sure that you monitor them so that they pay you back. With this structure of a securitization, the investors are the ultimate holders of the mortgage claim. But the problem is they don't monitor the borrowers, right? So there's no monitoring between these two because investors are thinking that they're buying a financial asset, okay, rather than lending to a loan. So this is where the problem occurs. So lack of monitoring with the securitization process. So like we said before, with the SIV, the way their business model is they buy the mortgages from the banks. And to buy these mortgages, they raise funding in the short-term commercial paper market, right? So their funding comes from commercial paper and their asset portfolios are mortgages, okay? So when the U curve is upward sloping, and when we say the U curve, we're talking about this graph over here. So here I've got the maturity of the loans or the interest rates instruments, and here is the interest rates, okay? So when the short-term interest rates are very low, you've got an upward sloping U curve where the longer maturity, the higher the interest rates, right? So which means that if the SIV borrows short-term, right? So they finance their purchase with commercial papers. So if they finance their purchase using short-term securities and they lend to long-term mortgages, so the mortgages are longer term. So as long as the U curve is upward sloping, they've got a positive spread here, okay? So that's no problem if the funding, if the interest rates are low forever. If the cash rate is always low, then this is how it looks like, okay? The problem only comes when there is a liquidity risk, okay? So what happens if they can't no longer roll over their commercial papers, okay? So when this is no longer available, they're going to run into a funding problem, okay? And to solve that funding problem, you would either have to sell your long-term asset or you've got to source your funds from somewhere else. Okay. So selling a long-term asset is not very attractive because you've got to discount the asset value a lot to be able to sell. So think about selling your houses tomorrow, right? If you have to sell your house tomorrow, you've got to offer a very steep discount to the buyer. And the second problem is, as you can see, the funding structure here relies on a positive yield curve, right? So when the cash rate or the interest rates by the central bank is quite low, then this is the case. But as the central bank increases their cash rate, then you will see that the spread between short-term and long-term interest rates start to narrow down. Okay, and that is where the problem comes in. Secondly, the SIVs essentially invest in mortgages, right? And as a result, they are exposed to the default risk of the borrowers. So SIVs face two problems. The first one is a liquidity problem, and second is a default problem. So when the borrower defaults, then obviously their mortgages start to lose value, and then it's very hard for them to sell their mortgage-backed securities now, right? So to illustrate the problem, so when the SIV, when the borrower defaults, let's say 100% non-recovery, that means you lose everything that you lend to the people. So if investors buy off all of their tranches already, then the losses are 100% borne by the investors. If the SIV, on the other hand, have some unsold securities, then they bear some losses. In contrast, if they have not sold any of the securities, they will find that they will lose 100%, right? In the event that they default, then the losses will be recognized on the bank's book. So the implication here is that we don't recognize the problem of the banks until it is very late. Okay. Question 11 is something that we have also touched on before. For this question, it is, what is collateralized debt obligation and what effect did they have on the credit crunch? Right. Oopsie. Sorry. So collateralized debt obligations are something similar to the structures that we discussed before. So in this case, this is an entity that is specialized in pooling different securities and then writing securities based on that portfolio. Okay. So for a CDO, so with a CDO, they've got, on their asset side, they've got different securities, right? So let's say they've got different mortgage-backed securities. So what they do is they first pull different securities together to form a portfolio, and then they're gonna repackage the portfolio to sell them into different securities. Okay. So for example, from these 4 different securities, I'm gonna write 3 securities to sell to investors. So similar to the SIV that we talked about before, their income comes from fees, right? So they earn the fees on the securities that they sell to investors. Their funding structure is also similar. They use commercial papers to buy the securities in their portfolio, and then they sell to investors. So funding structures are similar as well. So essentially, even though CDOs hold a portfolio of securities, right? But these securities are written on mortgages. And as a result, their underlying risk is the same as an SIV, which is the mortgage market. Okay. So their effect on the crisis is something similar to an SIV. So as the mortgage market started to have troubles, they find themselves in a very difficult position where their asset value erodes, meaning that it's harder for them to sell these securities. And at the same time, it makes it more expensive to raise funds in the commercial paper market. Okay. So as a result, they started to default, right? Because they can't find any buyers for their securities, and then they can't raise any funds as well. All right. I think I talked too much today because it's all theory. So in the next hour or so, we can talk about problems, okay? So we can talk about how to use money market instruments and how to use how to use forward rate agreements to hedge these interest rate risk exposures as well. So for the first problem, in this problem, we've got a company that borrows on a 6-month basis, okay? So this company wants to borrow $1.5 million for 6 months initially, and then they're going to roll it over for another 6 months, right? So the question here is, if this is the funding structure of the company, then how much interest have they paid over the first year of the loan? Okay. So this question introduces the euro-dollar market, right? The interest rate market that we talked about before. So let's take about 5 minutes or so in solving this question. So here I've got a loan with a principal of 1.5 million. And it is going to be LIBOR plus a margin, 1.25%. So the first loan is going to be 6 months. And then after 6 months, you want to roll it over for another 6 months. In the first 6 months, the LIBOR is 4.5%. And then in the next 6 months, it is going to be 5.375. The question here is, how much interest payment will I make after the first year? So as 6 months passes, my initial loan is going to mature. At this time, I'm going to pay back the principal as well as the interest, right? If it's a normal loan. But instead, what I'm going to do after 6 months is that I'm going to roll over 1.5 million for another 6 months. Okay. So here, this is going to be 1.5 again. So the interest that I am paying on this loan over the next year is going to be the interest on the first loan plus the interest on the second loan. Okay. So to compute the interest on the first loan, I'm going to take the principal times the interest rate for the first month. For the first 6 months. Okay. So here in the first 6 months, this is how much interest I pay. So these are annual rates. I'm just going to divide it by 2. In the second period, from month 6 to month 12, I'm going to compute the interest in a similar way. Okay. So here my principal is again 1.5 because that's how much I roll it over. And the interest is going to be 5.375 plus 1.25, which is the margin on top of the LIBOR, divided by 2 for 6 months. Okay.
Sorry, Van, I didn't get it. Like, why are we dividing by 2?
That's because it's a 6 months period.
So the labor rate 4.5 initially is for the whole year.
Exactly, spot on. So
Okay.
yeah. So all of these rates, if the question doesn't say anything, then you can assume that by default we're talking about an annual rate.
But they're saying that if 6 months labor is 4.5%, so is that 4.5 is for the 6 months or like what?
It's for the year. So 4.5 is the yearly rate.
Okay.
Yeah. So if the question doesn't say anything, then you can assume that this is a annualized rate.
No, but it's saying if 6 months labor is 4.5%.
So this is the LIBOR rate for a 6 month period.
Right.
So if you, let's say you go into the interbank market and you borrow,
Okay.
you will see the LIBOR rate for different maturities, right? So 3 months, 6 months, 9 months, 1 year, so on and so forth.
Right.
So they will all be quoted in a per annum basis.
Okay, so even if they're saying 6 months of a year, but we have to consider it as a for a year. Is that what you mean?
Yeah, so let's say if the question says the interest rate is 2% for 6 months,
Right.
then this is a 6 month rate. In this case, the 6 month here means the maturity of the LIBOR contract. I know it's a little bit confusing, isn't it?
Oh, okay. So I thought like it's a 6 months rate, 4.5%.
Yeah,
Oh,
yeah,
okay. Okay, but it's
yeah,
a yearly rate. It's a
yeah,
per
yeah,
annum rate.
yeah.
Okay, okay.
Yeah, it's quite confusing, I see. So in the exam, I don't think you're going to face the same problem because I've made sure to put the per annum next to the interest rate. But in case that you have any doubt, during the exam, I'll be available on Zoom, okay? Or you can email me if you're not sure.
Yep, thank you.
But normally, yeah, so if the question doesn't say anything, then it should be a yearly rate.
Right, right.
Yeah.
That's thank you.
Yeah, I know. Sorry, sometimes it's a bit confusing with all these maturities. Okay, so where were we? We are here. So to compute the total interest payment that we have paid over the year, then we just take the interest in the first 6 months plus the interest in the next 6 months, right? So if that's the case, we will find that the interest rate, the interest payment is $92,812.50, okay, in the first year of the loan. So this funding structure here is something very typical for banks, right? Especially commercial banks, and I guess for other firms as well. So if the firm perceives that the short-term funding market is much cheaper than the long-term market, then what they can do is they can keep borrowing short-term, and they will roll it over every time the loan matures, okay? For banks as well. So for banks, normally this is what you will see in their funding structure. If you think about a bank who lends, let's say in Australia, the banks in Australia has a big proportion in mortgages, right? In mortgage loans. So mortgage loans are very long-term loans. They could be 20 to 30 years. Whereas the deposits that the banks raise from us are either everyday deposits or like term deposits, which can last up to 5 years, right? So normally for banks, they tend to borrow short term, they take deposits short term, and they lend long term. So as their deposits matures, they will roll it over to the next maturity, okay? So as a result, if you're interested in commercial banking or banking in general, interest rate risk management is something very important, okay? Or liquidity risk management, sorry. All right. So the first question familiarizes ourselves with how an interest rate instrument works. So with short-term interest rate instruments, you don't normally see compounding in between. So they tend to be zero coupon bonds. So you buy the security at the current time, and then in the end, you will pay back a lump sum, okay? So in question 2, we are looking at how a FRA or a forward rate agreement works, right? So in this case, we've got a bank that sells a 3 against 6 FRA for $3 million. So when you see the word 3 against 6, that means the FRA is for a period of 3 to 6 months, okay? So this is the current time. This is the day that the FRA is settled. So this is the settlement date. And this period here between month 3 and month 6 is when you compute the interest. Okay. So this is the period over which you compute the payoff of the FRA. But the FRA is going to be settled in month 3. The purpose of the FRA is to cover interest rate risk caused by the maturity mismatch from having made a 3-month euro-dollar loan and having accepted blah. So for this question, these sentences are not too important. You can jump straight to this sentence here. So the agreement rate is the rate under the FRA. So if you think about a forward contract, for example, the agreement rate in the FRA is similar to a forward rate. Okay. So in this case, this is AR, which is the contractual rate in the FRA. The days between month 6 and between month 3 and month 6, 92 days. Assume that the 3 months from today, the settlement rate is 4.875. So the settlement rate is the actual interest rate that you observe in the market at this point in time. Okay, so this is something similar to ST. Determine how much the FRA is worth and who pays who. Okay. So I'm going to summarize the information first, and then we can take a few minutes to compute the answer. Okay. So before we solve the question, let's talk about the FRA contract first. So one of the parts of the question asks us to identify who pays who. So in a FRA contract, this is a forward contract on interest rates, right? So similar to the forward contracts that we discussed before, you could either have a long or a short position, right? So with a long position, you're looking at an upward sloping line. This is your interest rates or your settlement rate. This is the payoff of the contract, okay? So for a long position, as interest rate increases, you make profit. So the buyer makes the profit. And as interest rate decreases, it's the opposite, right? So for a short position, you're looking at a downward sloping line like this. So when the interest rate decreases below the agreement rate, this is agreement rate. So when that's the case, then the seller will make a gain and vice versa, okay? So these are derivatives contract. So by definition, their value depends on an underlying, which is the interest rate in this case. So going back to our question, the agreement rate in our question is, I think, how much was that? Oops, sorry, gotta pull this up. So the agreement rate is 5.5 and the settlement rate is 4.875, okay? So in this graph, it looks like this. Agreement rate is 5.5 and settlement rate is somewhere on the left, 4.875, okay? So in this case, because we're on the left of the agreement rate, then the seller or the short position in the FRA is going to make a gain. And the buyer, on the other hand, is going to make a loss, okay? So in other words, the buyer is going to pay to the seller, okay? So buyer pays to seller at the settlement date. Okay, so when interest rate decreases, then the seller gains and the buyer loses. So how much does a seller, how much does a buyer pays to a seller in this case? It will be given by this formula here, okay? So your payoff is given by this formula here. So to understand where this formula comes from, so we're talking about interest rate instruments, right? And we're talking about exchanging the interest payments between the buyer or the seller, depending on the interest rates on that day. So if you talk about a 3 versus 6 FRA contract, so in this contract, we are agreeing to pay or settle the interest differences for this period, calculated off this period over here. So what this formula is doing is that it's calculating the interest payments on the notional amount. for this particular period. Okay. So here SR minus AR, is the difference in the interest payment between the settlement rate and the agreement rate. Okay. And this is to account for the maturity of the contract. So for a 3-month contract, assuming there are 92 days within the month, then within 3 months, then the number of days here is 92. Okay. This second bit in the formula is to compute the present value of the interest payments. Okay. So we mentioned before that the cash settlement happens here at this point in time. But as we recall from a previous calculation, the interest payments that we are computing, the interest that you will receive under an interest rate instrument is going to be happening at the maturity of the instrument, right? So the interest payments are expected to be in month 6, but because the cash settlement happens in month 3, we need to adjust it for the present value, okay? And hence the second bit of the formula. So applying this formula into the question at hand. So in this case, we have identified that because the settlement rate is less than the agreement rate, then the seller is going to receive the money from the buyer, okay? So in other words, the buyer is going to pay to the seller. The value of the FRA, or how much cash is going to exchange between the two, is given by the notional value times SR minus AR times days divided by 360 divided by 1 plus SR times days divided by 360. Okay. So this was what we looked at before, SR minus AR times days. Okay. So if we put everything in, then we'll find that the payment is 4,000 something. Okay. There should be a negative sign here. So this 4,700 something means that in 3 months' time, the buyer of the FRA is going to pay to the seller about 4,700 something. Okay. Okay, let me have enough time. All right, so having gone through a FRA exercise before, now can you guys help me with this question here? So in this case, we've got a FRA question and it is a 3 against 9. Okay, so 3 against 9. That means the contract is going to be settled at this point in time, in 3 months' time. And the interest is going to be calculated over this period from month 3 to month 9. So the agreement rate for the FRA is 4.75%. The expected settlement rate is going to be 5.125. Okay. So you've got to be careful here. So here it says that the expected, you believe that the 6-month LIBOR rate in 3 months' time is going to be 5.125. So that means in 3 months' time, you think that for this, over this period, you can earn an interest rate of 5.125. Okay. So this corresponds to the same FRA period, which is the appropriate rate that you can use for the settlement rate. So in this case, you want to be speculative on $1 million. You think that there are 183 days within this FRA period. So within this period here, there will be 183 days. The question is, in this case, if you want to make profit off this FRA, would you buy or would you sell the FRA, right? And how much profit are you expecting? So let's take about 5 minutes on this question. The starting point, once again, is you want to look at the payoff functions for the two positions to decide where you want to be, okay? So here is a long FRA and here is a short FRA. Okay, so in this case, should I long or should I short a FRA contract? So I've got two answers. I've got 4 answers. So while I'm waiting, I'm just gonna properly label the graph. So here's the settlement, sorry, this is agreement rate, settlement rate, and so on and so forth. I've got 7 answers so far. All right, so I've got 4 people choosing long and 6 people choosing short. Okay. So in this case, what you want to do is you want to compare the agreement rate and the settlement rate. Okay. So the agreement rate here is 4.75%, right? And the settlement rate is expected to be 5.125. So here I'm looking at the right-hand side of the graph. So this is my settlement rate, which is on the right of the agreement rate. So in this case, I don't want to be a short position because I'm going to lose out. I actually want to be a long position. Okay, so the long position gains and the short position loses of the exact amount. So in this case, the short position is going to pay to the long position. And so if I want to make profit, I want to be in the long position, okay? Given that this is my expected future rate. So once I've identified which position to take, the next step is simply just to compute the value that I will receive under the FRA. So in this case, I'm going to apply the formula that we saw before in the lecture. And I'm just going to compute this amount here. Times the number of days divided by 360. And then everything divided by 1 plus SR 183 divided by 360. So we use an American textbook. So by convention, they assume 365 days a year. So this is where 360 comes from. Since the agreement rate is less than your forecast, you should buy a FRA. So this is what we talked about before. In terms of the profit, the expected profit. So if we apply the formula that we saw on the previous slide, then we can see that the expected profit is about $1,800 something. Okay. Any questions so far with a FRA contract, guys? So similar to what we discussed before with the forward contracts, I just need you to remember that the FRA contract is just a forward contract, right? The only difference is it is on interest rates rather than currencies. Okay, moving on to the last question. So recall the FRA problem presented as example 11.2 in the textbook. Show how the bank can alternatively use a position in euro-dollar futures to hedge the interest rate risk created by the maturity mismatch it has with 3 million 6-month euro dollar deposit and roll over euro credit position indexed to 3 months LIBOR. Assume that the bank can take a position in euro-dollar futures contracts that matures in 3 months and have a futures price of 94. Okay. So before we dig into the features of a futures contract, let's look at example 11.2. So in this example, we have a 3 against 6 FRA. So we've got this bank here that has a $3 million exposure. So what they do is that they make a loan of 6 months and they finance this loan using short-term deposit. Okay. So they finance the deposits. They finance the loans with the 3-month deposits, meaning they have to roll it over after 3 months. So the bank is concerned that if the 3-month LIBOR rate falls below expectations, then the euro credit is rolled over at the new lower base rate, making the 6-month deposit. Hang on, sorry. Sorry, I mixed up between the loan and the deposit. So in this case, they lend out 3 months and they deposit 6 months. Okay. So here is the deposit. So they take a 6-month deposit and then they lend out 3 months and they roll over after 3 months. Okay. So the risk here is that when they have to roll over the loan in 3 months' time, the interest rate can fall below expectation, and at that point, they will be unprofitable, right? Or their profit will reduce. So to protect itself, the bank can sell a FRA, 3 against 6 FRA, to basically lock in an interest rate for the next 3 months, okay? So the question here is, instead of using a FRA contract, can I use futures contract to hedge this interest rate risk instead? Okay, so here, if I want to use futures contracts, how does it look like? So for now, just write down the key details, guys, about this bank's exposure, right? So in this case, their deposit is going to stay for 6 months, but they have to roll over the loans after 3 months. So their worst case scenario is the interest rate after 3 months is going to decrease, which makes their profit reduce. So before we look at the solutions, let's talk about interest rate futures first, right? So if we recall from week 5, a futures contract is basically very similar to a forward contract. So for long futures, you talk about agreeing to buy the asset at the futures price F, okay? Your payoff function is therefore just ST minus F times the contract size. For short futures, sorry, this is the opposite. For short futures, you agree to sell. I mixed this up again, sorry. So for short futures, you sell the asset at the futures price of F, okay? And as a result, your payoff is F minus ST times the contract size. For interest rate futures, the price is quoted in percentage points. So from 0 to 100. So for example, if the futures price is 95 points, that will be equivalent to an agreement rate of 5%, okay? So if I say I buy the futures at 95 points, then basically I'm just buying the interest rate instrument at 5%, okay? So if we look at the payoff for a interest rate futures, then this is what we're looking at, right? It's very similar to what we saw before with the FRA. So on the vertical axis, I've got my payoff, and on the horizontal axis, I've got my futures price, okay, from 0 to 100. On this graph, this is the futures price in the contract. So with the upward sloping line here, I'm looking at the long futures. And with the downward sloping line here, I'm looking at the short futures, okay? So for a long futures, it is going to make gains when the futures price increases, yeah? So when I go from 95 to 96, then I'm gonna make a gain on my long futures contract. So this is something you have to be very careful about though. So when you talk about interest rate futures, when the futures price increases, let's say from 95 to 96, that means the interest rate has decreased, right? So when you go from 95, which is basically 5% to 5% to 96, then that is 4%, right? So when the futures price increases, the interest rate is going to decrease, yeah? So in other words, for a long futures contract, you will gain when the interest rate decreases. Alternatively, for a short futures, you will gain when the interest rate increases, yeah? So this is a little bit counterintuitive, especially if you want to compare this with the FRA contract. Just remember that they are based on two opposite prices, okay? So the futures price is the opposite to the interest rate. All right. So having reviewed what a futures contract is about, let's apply that into this problem here. Okay. So in this problem, so if we go back to the example that we saw before, how come my mouse doesn't really work? Right. So in example 11.2, for our deposit, let's just forget about our deposit. It doesn't really matter here. For our loan, so we know that we are going to borrow, we're going to lend for 3 months. And then after that, we are going to roll over our investment for another 3 months, right? So our interest rate exposure is going to be here. We don't know how much we are going to roll over our loan at. And as a lender, if I'm investing, then I want interest rate to increase, right? So here I will gain if the interest rate increases. In contrast, I will lose if the interest rate decreases. Okay. So from my point of view, therefore, if I want to hedge this interest rate exposure, I want to enter into a futures contract that will gain when interest rate decreases, yeah, to offset the losses that I'm expecting. Okay, so here I want a futures contract that gains when interest rate decreases. So if I go back to the payoff functions of the two futures positions, the one that is going to gain when interest rate decreases is the long futures position, right? So here, when the interest rate decreases, I'm going to make a gain. So to hedge this exposure, what I'm going to do is I'm going to enter into a long futures for a 3-month contract, right? So the futures has a maturity of 3 months, and I'm going to enter into a long position, okay? So in this case, we assume that the futures price is going to be 94. So F, which is our futures price, is 94, okay? For a long futures position, our payoff is going to be given by ST minus F and times a certain factors I'll show you later on. Also, one thing I didn't show you here on the slide is that in example 11.2, the expected future settlement rate was, I think, 5.125%. Okay. So in the context of a futures contract, this is going to be your ST. I mean, you're going to calculate the ST based on this expected rate. So as I mentioned before, the futures price is simply just the percentage point, which is 100% minus the interest rate. Okay. So to compute the expected outcome of a futures hedge, let's rewrite the information in the question first. So AR is the agreement rate, 6%. This is equivalent to the futures price of 94. The expected future 3-month LIBOR rate is 5.125%. So that will be equivalent to 94.875 points, right? So this is ST that we mentioned before. So to compute the payoff of these futures, so when the interest rate drops to 5.125%, the futures contract is going to make profit, right? and the profit is computed as follows. So ST minus F for the futures payoff times contract size. So in this case, we have 3 million, right? I'm going to times it by 3 million. Then I'm going to have to adjust it for the time, the maturity of the futures contract, right? So the futures price that we see is the price in the per annum basis, right? So we have a 3-month futures contract. We're going to have to adjust it for the 3 months period. So I'm going to take the yearly rate and I'm going to divide it by 4 for 3 months. Okay. Let me check the answer here. Yeah, so if we do that, we will find that we get about 6,500 and something. Okay. So I find that this formula is easier for me to understand rather than relying on the approach in the textbook. So in the textbook, this is how you will compute the futures payoff. Okay, so that is all the tutorial questions for today. Any questions so far, guys?
No, I'm fine, thank you.
Okay. So if there's no questions, I'm just going to stay back for a while. So if you have any questions about the assignment, now is the good time to ask, okay? Otherwise, if you want to leave early, then you're welcome to as well. And I'll see you next week, okay?
Thank you.
Yeah. So some people did ask me something about the assignment in the chat box. If you want, you can raise the question here.
Miss?
Yes.
Yeah, I'm the one that asked you about the option price. For
Yeah,
version
yeah.
2.
Here?
Yeah, you can call me Heng.
Okay.
That's fine, that's fine.
Can you repeat the question, please?
Yeah. So because in version 2, we are having 2 exchange the strike price the strike price in
USD and then in
USD,
Australian dollars.
in USD.
Yeah.
So I need to get the cross rate, which means I need both USD and GBP in USD. So I'm thinking that if I use the when I'm calculating the cost of option, when I'm using the percentage, the figure for the price to times the sales figures I'm using, is it okay?
Can you repeat? Sorry, it's very low. I can't hear you.
Do I have to repeat from the beginning?
No, you were at option premium.
Option. Okay. So so the option premium is the percentage,
Mhm.
right? And I will use the percentage to times the sales figure that I use.
Yeah, so this is a little bit more complex. So with the option premium, let's say your first contract is the pounds over the USD, right?
Yeah.
So for this contract, you've got an option premium of, let's say, 5%.
Mm-hmm.
So you're gonna take the sales, the expected sales in GBP, sorry, and then you times it by 5%, and that will give you the USD option premium. So that's the first figure. And then yeah.
Okay.
And then
So
you're gonna
I use the percentage for the GBP premium to times the sales for GBP.
Yeah.
And then for AUD.
So for AUD, you're gonna have another option contract. So for that contract, you're gonna have to compute the USD premium for the second contract as well, right? I think because both of the currencies are quoted in the USD.
Mm-hmm.
And then you want to add them up, and then you convert this USD into the AUD at the current spot exchange rate. Does that make sense? So if you buy two options today, then these are the two figures, these are the two option premiums that you're going to pay. So at the current time, you want to compute the AUD equivalent of the USD premium payment. Let me write it down to see if it's clearer. So let's say I'm just going to make up a number. So my sales in GBP times, let's say, 5%, and that will give me the USD premium for option 1. And then once I obtain the USD from the first step, I'm going to convert the USD into the Australian dollars. Let's say it's 5%. Then I've got the USD premium here. This is my second option.
Oh, so which means I need to use the GBP and convert it into USD and times the percentage, is it?
So this second figure, yes, so this will be the amount of USD that you acquire from the first option. Right, so in the first step, you convert the GBP into the USD.
Mm-hmm.
And then in the second step, you convert the USD into the AUD.
Okay.
So the amount of USD that you want to hedge in the second step is given by the conversion in the first step, if you know what I mean.
Okay. And then I will use these two premium and sum it up, right?
Yeah, so here you're gonna have a USD figure for the premium. then you want to compute the AUD equivalent because at the end you want a AUD figure, right?
Yep.
For your option H. So because if you buy an option today, you're going to pay the premium today. So when you convert the USD into the AUD, you're going to use the spot rate, right, to convert.
Okay. Yeah, I think I got it.
Okay,
Thank
that's
you.
good. Yeah, so version 2 is a bit harder, sorry.
That's fine.
But,
I have a question as well.
Yeah, sure.
All right. So with respect to the table
Uh-huh.
scenario analysis.
Yeah.
So this X, which is in the middle of the table, it's the same for all scenarios?
Yeah, so X is going to be your forecast exchange rate.
All right. And would you explain a bit on these percentages, forward and options?
Percentage.
75, for example, 75 forward, 25% options.
Oh,
and
okay.
Yes, please.
Yeah, sure. Hang on, where's my pen? I don't know where they hide it. I'm still on the whiteboard. I don't know where my pen is. Hang on. Sorry, let me just share again. Right, so let's say I've got like 100 million pounds as my overall exposure. And then if I do like a 75% option, hedge, and then 25% forward hedge, that means I'm going to hedge 75 million pounds using options. And I'm going to hedge 25 million pounds using forward, okay? So I would say that you should do the 100% options and 100% forward hedge first. Once you've got the outcome of these two, then you can just, in Excel, you can just take the 75% times the option outcome plus 25% times the forward outcome.
All right.
Yeah.
So we have to, how we can find forward, that's the expense?
Forward, sorry, what's the question?
So how we can calculate 1 million forward?
Oh, so this is, so I assume that this is your
100
forecast sales, right? So let's say I forecast that in March 2021, the amount of sales that I generate in the UK is going to be 100 million.
And then we multiply this figure by the forward rate in March.
Yeah, yeah.
All right, to have the complete forward hedge strategy. All right, thank you. And for the option, we have to find the premium for the whole amount of exposure.
Yeah, so the option premium will be calculated off the amount that you hedge, yes. So for example, if you look at the data, the option premium is given per unit of currency. So yes, so you're gonna have to times it by the size.
Thank you.
So we have I actually have a problem after finding the historical data.
Mhm.
And I actually found out the PPP. And I actually also thought of trying out the regression analysis as well.
That's good.
But I don't know how to relate that to forecasting. But I'm stuck there.
So when you use regression, how are you going to use it to forecast?
Yeah, that's my question. Actually,
Yeah. So that's something that you have to find out. So I guess if you can't relate the regression to forecasting, then you can use the other methods like IRP or PPP, or taking the average over the last year. Okay.
okay.
Yeah.
Is there any method to find out the forecast?
So forecasting is not easy, and so you've got different methods. As a result, it will be advisable to use different methods to see if you get similar answers or not. Okay. So it will be up to you to argue for like either a best approach to forecast, or you want to use average or whatever. So that will be up to you to argue.
Okay. So the whole assignment is based on us assuming, or do we have to check the actual rates on the Afterpay in the UK segment?
What rate are you talking about? Is it the exchange rate or?
The exchange rate.
So the assignment is about using the different information we have learned to forecast the exchange rates. And then based on that knowledge, you want to hedge your exposure. So yeah, I guess a lot of the times you've got to make assumptions and you've got to justify your assumptions.
Okay.
Yeah.
Thank you.
Yeah. So as I mentioned in class, I think before, I will be easy on the earnings forecast because that's not the main point. But of course, if you make a more reasonable argument, you get more points on that. The main focus of the assignment will be on the exchange rate management side. Okay. So make sure you put more effort on that part.
Okay. Thank you.
Any more questions, guys? So I guess the second version is harder in terms of, as I mentioned to Hank before, with the option premium calculation. So that's something you've got to be careful about. And also in terms of forecasting the sales in the UK, you don't have much historical data. So I guess you can rely on the industry information in the UK segment for the second version. Okay. Anupam has a question on writing the report. Do we have to write down the process we work on in Excel and the remaining questions? So you've got to think about, let's say, if you present to me table 2, right? And then these are different numbers. You've got to tell me what is the rate, for example, for your option hedge. How do you calculate the premium? Where do you get the forward rate from? Right. So my point is, you don't have to write like in this cell, I've got this is a formula, so on and so forth. But you've got to make sure that you communicate your method to the reader, if that makes any more sense. And also in the Excel file, guys, make sure you leave the formulas for me. So if I don't understand something in your report, I can go back to the Excel file. Megana, no, I don't think there will be an extension because I published the assignment for a long time. And no, I don't think so. Sorry. Any other questions at all? So if you, yeah, so I think I mentioned this to some of the students before, but this is meant to be an individual assignment. So I don't expect like, I think if you spend a week on it, you should be able to finish it. So if you started the assignment last Friday and you work consistently on it, you should be able to submit on time.
And the last question, please.
Sure.
With that table, would you explain a bit how we can run option, how to find the option figure? Because it includes premium and the risk exposure. So which figure should be placed in this cells for option? So
if you go back to, I think, week 8, when we talk about option hedge, then the figure will be the final proceeds, right? Final AUD proceeds from your hedging. So that means you want to calculate the gross proceeds from the option, from the conversion using the option contract, and then you minus the option premium. Okay. So for example, if I, let's say going back to here, so if this is how much I want to hedge, and let's say the exchange rate that I convert the GBP into the AUD. Let me write the other way so it's easier. Let's say it is 1.5, okay? So the total AUD proceeds, the gross AUD proceeds, sorry, from the option hedge, it's going to be 1.5 times 100 million. So that will be 150 million AUD, right? And then let's assume that the option premium for this particular option is going to be 0.5. Okay, let's say 0.5. That's too much, 0.05. So the option premium is going to be 100 million times 0.05, and that will be 50,000. All right, is my calculation correct? This is, who calls me? I'm using my calculator. No, this is not correct.
That's 5 million.
Yeah. Right. So you then want to compute the future value of this figure like we did in the class, right? So at the current interest rate of 0.25%, I think, per year, you want to convert this into the future value. So let's say this is 5,000. I'm just going to make this number up for the purpose of example. So this is your option premium cost. And to compute your option outcome, the hedge outcome, I'm going to compute the net proceeds, okay? Which is the difference between the gross proceeds and the option costs. So this is going to be the number that you put in your table 2.
All right, thank you.
Yeah. In the case you do 100% option.
Yeah, because I was confused between the premium or the risk exposure. Thank you.
Yeah. Yeah, so your final outcome.
Thank you.
Sorry, Miss.
Yeah.
Would you mind to repeat this part again?
Yeah, sure. With the total proceeds.
Yeah, yeah.
So are you okay up until now? Up until here?
Where are you? Oh, okay.
Yeah.
Yeah.
So you're okay so far?
Uh-huh.
So the second part is to compute the option premium cost, right? So how much does it cost you to buy these options? So let's say my total exposure is here, and then my option premium is here. So the AUD value of the option premium is going to be here. Okay. So I'm just going to take my exposure and I times it by the option premium per currency. So of course, for you, in that case, it will be a little bit more complex. So for you, you'll be looking at this calculation here for the option cost. So assuming that you have come up to here, which is the total AUD value of your option premium, then the next step you want to compute is you want to find out the future value of the option premium, okay, at the current Australian interest rate. So you take this amount and you times it by the interest rate over the next however month. Then the proceeds, let me call this X2. So the net proceeds for your option hedge is going to be the gross proceeds minus the option premium in future value, which is X2. Does that make more sense?
1.5, this rate, 1.5.
Yeah.
That's the expected exchange rate that we calculate.
So this is the option rate, right? So if you go back to our week A, I think with option hedge. So from the option rate, right, it's a bit complex to discuss. So with options, you've got to
that's the strike price. Which one's that?
So with options, you've got to decide whether you exercise the option or not. So this rate depends on your decision to either exercise the option.
I know, no. What's that? Where we get this figure, 1.5?
The strike price.
What's that? That's the expected exchange rate? I don't know what's that, 1.5.
So this is the rate under which you exercise. This is the rate at which you convert the foreign currency into the AUD in the option hedge. Right.
So that's the rate we find in the website, which is CMO?
Yeah, CME. Yeah. So I think I provided it to you on the slide before. Yeah.
That's the rate we can find in CME group website.
So yeah, so this is the option rate.
Or the strike price.
The strike price, yes. So this is the rate under the option. So you've got to be a bit careful because, as I mentioned before, with option hedge, you don't always use the option strike price, right? Because it depends on whether you exercise the option or not. Does that make sense, Nekis?
Yes.
Yeah. So you've got so you've got three different scenarios for the exchange rate: X minus 10%, X, and then X plus 10%.
Correct. Whether to these rates we exercise it.
I have a question for the future value of the cost option premium. Like we have to find the future value, which means we need the interest rate, right?
Uh-huh.
And I'm looking for the rate from trading economy,
Yeah.
and the rate given is in daily. So
Is-
how do I need to convert it into to semi-annually, or
so you got the daily rates, but do you have the per annum rate, or has it been converted to daily?
it
So what-
shows that the frequency is daily.
Yeah, but is it like PA? Like what's the, so I can give you like a daily interest rates for every day the market trades, but it is still quoted in a per annum basis.
Okay, because it
Does that make sense?
because it in I got what you mean, but
Yeah. So in that case, I don't think they will give you like a daily rate. I think they'll give you a PA. Yeah. So in that case, you want to choose like a day that is closer to March 2021.
I'm not sure, but I didn't see that they are saying this rate is per annum. Can I assume that it is per annum?
What is the number?
25%,
Yeah.
0.25.
So that should be yearly. So the current
Okay.
cash rate is 0.25%. I mean,
Yeah.
0.25%.
Okay.
So that's yearly.
Okay. Thank you.
Yeah, guys. So I think that's that's basically the hard part of the option of the assignment. So you should be fine, I think. So once again, with option H, just be careful. You want to decide whether you exercise the option or not based on your level of exchange rates, right? So X minus 10 might be different from X, might be different from X plus 10%. All right, I've got to leave, guys, for family reasons. And I'll be a little bit free on Thursday. So if you want to book an appointment or something on Thursday, I'm happy to do so too. Other than that, all the best with the assignment. And I will see you next week. Okay.
Thank you, Miss.
Okay.
See you.
Thank you.
See ya.